Globant, GLOB on New York, release of earnings, good earnings report, but in line. And when I say good, it's because year over year was quite good. It's a growing company though, so it was kind of expected, kind of baked in. Shares are actually down 3.5%, and now we got to figure out what to do because this is in our model portfolio, and it's been a high grower. It's been a great performer, and always tough to let something go if you done so well with it. Especially when they beat earnings, but you still gotta kind of not be emotional and see what you can do. So I'm gonna take you through our process a little bit. I can't do everything, but I'm gonna take you through a quick analysis of how we go through it and then how we think, and that's the important thing. Before that, let's just quickly go over the earnings here. Revenue was up 23%, obviously good number. Earnings per share was up 32.5%, good number. But a very small beat, as you can see from our graphic there on the right. It's literally a 0.0 something. It was slightly positive, but further to the right of the decimal than we're showing. And 1.9% on earnings. So, the market understood this was a growth company. And it did a good job. But you can't be upset when company puts up 23% revenue growth, 32% earnings growth, even if it was baked in. But some people kind of go, maybe we should sell, especially after the run. So when you see the stock chart, and I'm kind of getting in that camp too. So I'll show you what I mean. So here's our model on Globant, and I just ran it. I didn't do any assumptions other than what the default does. And we're only getting a $42 value, but it does not stop there. So please stick with us. We know they're growing at about 23% revenue line, 32% earnings per share line. So typically revenue and capital kind of grow the same. So that's our bottom chart. And you can see our capital growth right now is kind of off the chart in the trailing 4 quarters, and that's actually at 53%. But I think you would assume now that we're showing a 23% growth, but you got 50, and maybe a 20. Let's just go 25. I want it to be close to the revenue growth that they're showing. Now 32% earnings growth. I typically think that means the return is getting better, right? That's how you calculate. Maybe margins are even better. So that's why there's no capital growth to get that better earnings. You're just being more efficient, so that improves your return, and it's already getting bumped up because earnings estimates are bumping it up just a little bit. So we get to 26%. I'm fine with that assumption. That all seems really good to me so far, but we're only getting a $55 valuation. So what else could be going on? Well, first of all, does it fade this much in the first 5 years? And I'm going to just assume that that's okay, that's reasonable. It goes back down to about 20%. We have 19.7. I'm just going to round it off to 20. Okay, so we're up to 55.92. That's clearly off from the market, and it all comes back to fade. Now listen, this is how it's done. This is just how the game works, and how to value stocks, because it's all about future cash flow. And it would be nice if we could just say, oh, there's the earnings, we'll just slap a multiple on it and move ahead. But we don't do that. It's not a good way. It's been proven not to work. So we want to talk more about excess returns and how long. So we have a pretty severe fade here, if you can see, built in after year 5. It looks like a ski slope. I always call it. It looks like a ski jump, right? Like in the Olympics. And I think if we just don't make it so steep, we start to show value. Now, the default model is showing a 10% decline in the return on capital, and in the long run earning 6% return. And I'm just going to change that to 8 and 8. I call it a way station. I don't really, it's just 2% on each one of those variables in a positive direction to make the company more valuable. And now we're getting fair value, so that's good. It's still a fade is built in by, but we're not saying this company is going to be amazing forever, earning 20% forever. That would be a very poor assumption. We're saying it's going to earn 8% in the long run. That's a very normalized number, and it's worth just a little bit less. So I kind of really like reverse engineering, because this is my betting line now. This is giving a good football team a betting line, like 7 points. So you got to win, but you got to win by 7. So now we know the betting line. Can this company earn a higher rate of return overall than this, and grow at about this rate? And I'd say probably can. I think it can. That's hard to say. It's been a great company so far. It's early days. It's still small though, so you can grow. A terrific balance sheet, by the way. Barely any debt. Good working capital. So everything's good. But I'm gonna say you could probably take a little bit of a pause here. And the reason I would say that is more the environment we're going into, and not so much on what the companies are doing. We just had the market come off pretty hard earlier this week on inverted yield curve and possible recession, right? Well, okay, so this is a small cap IT, high growth. That doesn't go great with recession, okay? Sometimes you can, because you're doing something different, you can power through a recession unaffected, but typically I'd say no. This actually hurts growth. So I just think it's fairly valued under these assumptions. These are reasonable assumptions. They're not aggressive assumptions. They're very reasonable. Sometimes the market's unreasonable. And the other thing you got going against you, and not that I'm a trader, but when you get a pop like this over the last year, I mean, this stock is up 69% in a calendar year. Like, when I say calendar, I mean like from this time last year. In a 5-year CAGR, 51%. I mean, that's tremendous return for people. So some people are just going to cash out, especially when they hear recession on the horizon, all the risk factors I just talked about. So to me, there's just enough evidence here to at least trim it, given that there's some risk on the horizon with recession, and this is not a recession resistant kind of company. This is a dependent on the economy kind of company. So love it though. And if you're a super long-term holder, and I think you're going to be fine. But there's degrees of traders, day trader every single day, chop, and then hold, buy a company, great company, and hold forever. I'm towards the buy and hold it end, but when I have a recession in my face and I know I've got a fairly risky with a massive run recently, I take some off the table. That's how I play it. Thank you for watching our investment video. This is the same analysis we provide to our institutional clients. Want to improve your portfolio? Simply subscribe to our YouTube channel below, or better yet, go to our video website at video.fsavaluation.com and get access to the entire library.